Hi, I'm Bill Spalding. Welcome to WCS Money Tutorials. I made other videos talking about how bond prices are affected by interest rates and bond duration. The recent collapse of Silicon Valley Bank further illustrates these principles. I will discuss why bond prices spiked when the bank collapsed in March 2023 and when is the best time to take advantage of these price spikes. What happened? Venture-backed startup firms received millions of dollars. These firms put their cash in accounts at SVB. Most accounts greatly exceeded the $250,000 FDIC insurance limit. SVB invested in long-term treasuries and federal agency bonds to earn a higher yield. Interest rates rose. Long-term security prices declined. Startup firms received less funding from venture capitalists, so they started withdrawing their money. The bank started selling its securities at a loss to provide cash for the withdrawals. SVB disclosed its balance sheet problems and tried to raise more equity to remain solvent. Account holders found out. Since most of the money was uninsured, account owners feared that the bank would go under. These firms belonged to the same social networks, so word of the bank's problems spread rapidly. Consequently, more firms started withdrawing all their money, creating a run on the bank, which caused its failure. Good investment advice, as demonstrated by Silicon Valley Bank, is to never buy long-term bonds or funds based on such bonds when interest rates are low, especially when interest rates are near zero. When interest rates are near zero, as they were during the COVID-19 pandemic, then they have nowhere to go but up, which will cause long-term securities to decline in price, which is exactly what happened to Silicon Valley Bank's main assets. However, the collapse of SVB caused bond prices to spike. The size of the spike was proportional to the term or duration of the security. Here, you can see that short-term bonds spiked, but not by much. Intermediate-term bonds increased in price by a higher percentage, and long-term bonds benefited the most. Among long-term bonds and bond funds, securities with the longest duration had the biggest price spikes, as you can see here with the Vanguard Long-Duration Treasury ETF, increasing 9.3% in a few days. I explained duration and its effect on bond prices in other videos. Links to those videos are in the description. Prices have drifted downward since then, but they are still higher than before the spike. Since interest rates are still expected to increase, prices will probably decline more during the spring and summer of 2023. EDV also spiked the most at the start of the COVID-19 pandemic, benefiting from both the flight to quality and the expectation that the Federal Reserve would lower interest rates, which it did. There are two reasons why the bank collapse caused bond prices to spike. The first reason is that investors worried that other banks may also be in trouble, so they wanted a safe place to park their money, which is often called the flight to quality. The second reason is that many investors expect the Federal Reserve to lower interest rates to prevent additional failures, so they anticipate that interest rates will soon decline, which will cause bonds to increase in price, especially long-duration bonds. Since long-duration securities increase in price the most, these securities benefit the most from these spikes. However, it is unlikely that central banks will lower interest rates soon because inflation is still high, which is why I believe bond prices drifted downward after the spike. The Fed is more likely to pause raising rates or limit any increases to 0.25%. I still expect the Fed to raise rates by 0.25% at their March meeting. Some additional interest rate increases are still expected, but many people now believe that the top rate will not exceed 5.5%. When interest rates peak, this will be the best time to buy long-duration bonds or funds. To take advantage of price spikes, buy long-duration securities at the first sign of trouble, but only when interest rates are near their peak. Set limit orders to sell at various prices so that you are more likely to get the highest prices. Even if you miss the spike, the price should remain higher long enough for you to sell at a profit. Thank you for watching my video.